At some point, every system built on debt starts telling the same story. Grow or fail. Not because people are greedy, not because leaders are stupid, but because the math quietly demands it. Here's the uncomfortable truth most explanations skip. Debt doesn't just finance growth. It forces a bias toward growth, even when growth no longer makes sense. And once that bias takes hold, stopping becomes harder than crashing. Let's slow this down. Imagine a calm, ordinary moment. Country, company, a household. Nothing dramatic. No crisis headlines. Just borrowing a little money to move forward. That's how it always begins. Debt feels harmless at first because it solves a present problem using future confidence. You don't need the money now. You need what the money will produce. A bridge, a factory, a degree, an expansion. Debt says, trust tomorrow to pay for today. And most of the time it works. At least at the beginning. That's why debt is seductive. It creates progress before the cost shows up. But hidden inside that deal is a quiet condition. The future must be larger than the present. Not better, not wiser, just bigger. More income, more output, more tax base, more users, more revenue. Debt doesn't ask for stability. It asks for expansion. This matters now because we've reached a strange moment in the global economy. Debt levels are historically high. Growth is slowing. And yet the pressure to stimulate, invest, and expand has never been louder. Everyone agrees something feels fragile. But the system keeps leaning forward anyway. Why? Because once debt exists, standing still is no longer neutral. Standing still becomes dangerous. Let's walk through how this actually works without jargon. When you borrow money, you don't just owe the amount you borrowed. You owe more. Interest is the rent you pay for time. And that interest creates a simple requirement. At some point in the future, more value must exist than exists today. That value doesn't have to be evenly distributed. It doesn't have to be fair. It just has to be there. Now scale this up. Companies borrow to expand operations. Governments borrow to fund programs. Households borrow to smooth life. Each loan is rational on its own. But stack them together and something changes. The entire system becomes dependent on growth to remain stable. Here's the part most people miss. Debt repayment does not come from savings. It comes from cash flow, future income, which means the future must reliably produce more income than the present. Not once, every year. That's fine in a young system, population growing, productivity rising, new technologies unlocking new output. Debt works beautifully there. But as systems mature, growth slows naturally. Markets saturate, populations age, returns diminish, and debt does not care. The payments don't slow down just because reality does. So what happens? The system develops a growth bias. Policies, incentives, and narratives start favoring anything that boosts short-term expansion, even if it creates long-term fragility. This is where things get uncomfortable. Because growth bias doesn't feel like a mistake. It feels like responsibility. A government that slows growth risks unemployment, falling tax revenue, and debt stress. A company that stops expanding risks declining margins and investor punishment. A household that doesn't increase income struggles with fixed payments. So everyone leans forward. Not because it's optimal, because it's necessary. This is how debt quietly reshapes behavior. Let's make this concrete. Imagine a government with a large debt load. If the economy grows at 5% and debt costs 3%, things feel manageable. But if growth drops to 2% while debt costs stay the same, now the debt gets heavier even if nothing new goes wrong. The solution offered is almost always the same. Stimulate growth. Invest more. Spend now to grow later, which often means more debt. It's not stupidity. It's arithmetic. The system is trapped in a loop where growth is the escape hatch. And the longer the loop runs, the narrower that hatch becomes. This is where irony sneaks in. Debt is often justified as a tool for stability. But over time, it makes stability impossible without growth. A system that once borrowed to smooth volatility becomes one that cannot tolerate slowing down. Even healthy slowdowns feel like emergencies. Now zoom out. This bias doesn't just affect policy. It affects culture. We start equating progress with speed. More construction, more consumption, more leverage. Flat becomes failure. Slow becomes suspect. But here's the uncomfortable math hiding underneath all of this. Debt grows exponentially. Real economies rarely do. Interest compounds automatically. Productivity does not. That mismatch creates pressure. And pressure changes incentives. Instead of asking, is this valuable? The question becomes, will this grow fast enough? That's how low-quality growth sneaks in. Projects that look productive on paper but don't meaningfully improve resilience. Financial engineering that boosts numbers without boosting fundamentals. Asset inflation replacing real income growth. It all counts as growth. For a while. Until it doesn't. This is where hype and reality diverge. The hype says growth solves debt. The reality is debt demands growth and punishes anything that interrupts it. That's why economies with high debt loads become fragile to shocks. Pandemic, a rate hike, a supply disruption. Suddenly growth pauses, and what felt manageable becomes dangerous very quickly. Not because the system was weak, because it was tightly balanced on continued expansion. Here's the part that feels almost absurd. The more successful debt finance growth has been in the past, the harder it becomes to stop. Success builds expectations. Investors expect returns. Citizens expect services. Markets expect expansion. Debt locks those expectations into contracts. You can renegotiate narratives. You can't renegotiate math easily. So instead of asking whether growth should slow, systems ask how to force it to continue. Lower rates. More stimulus. New incentives. Each step buys time. And each step deepens dependence. This is how growth bias becomes structural. Not ideological. Structural. Even leaders who understand the risks are constrained. Choosing slower growth means choosing immediate pain. Higher unemployment. Budget stress. Market backlash. And debt ensures those costs show up fast. The benefits of restraint arrive slowly, if at all. That asymmetry matters. It's why debt-heavy systems rarely choose long-term resilience over short-term expansion. Now let's zoom out even further. On a global scale, this bias synchronizes behavior. When one major economy stimulates growth to manage debt, others feel pressure to follow. Capital flows, currency competition, trade dynamics. Growth becomes not just domestic policy, but geopolitical necessity. Slowing down risks falling behind. So the race continues. But here's the quiet risk most people underestimate. Growth bias works until growth itself becomes unstable. When growth is pulled forward using debt, the future becomes thinner. You borrow tomorrow's demand to satisfy today's obligations. At some point, tomorrow arrives, and there's less there than expected. That's when systems face a choice. Accept slower growth and restructure. Or try to restart the engine again. History shows what usually happens. Short-term fixes win. Not because people are evil, because the system rewards them. This is why discussions about too much debt often go nowhere. The issue isn't the number. It's the behavior debt enforces over time. Debt turns growth from a strategy into a requirement. And requirements don't ask permission. So here's the uncomfortable question to leave you with. If a system cannot survive without constant growth, is growth still progress? Or is it just the fuel keeping a fragile structure upright a little longer? Because once debt sets the pace, slowing down isn't just hard. It becomes the most dangerous move of all.